The first thing that founders have to understand about VCs is that VCs and founders are aligned until they're not aligned.
Right.
And
Yep.
it's actually almost inevitable that you would be misaligned with your VCs at some point on the startup journey. It doesn't have to happen now. It can happen 10 years from now. But it very often happens. And we have gone through the ups and downs of that again and again and again and again in our companies. We know how it looks. So VCs are not your friends. I'm not saying they're your enemies, right? They're business partners who have their own set of interests, wants, and needs, right? And you have to recognize that.
Hi, guys. Welcome to the How I Raised It podcast, the show where we get an inside look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Itamar Novick of Recursive Ventures. Recursive is a San Francisco-based VC fund investing in pre-seed and seed startups, disrupting industries through the use of data and artificial intelligence. In this episode, we talk about anti-patterns, things that look good but that can derail a startup, how he started 2 angel funds and how he used those to raise his current $30 million fund. Itamar also shares a ton of tips for building a fund, including why you might not want to raise a fund, tips for raising from institutional investors, setting up your back office, and more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup or FundingStack.com if you're a VC or advisor. Both platforms will give you access to an awesome collection of tools for raising capital, including a massive investor database, a new Get Intro tool to help you get warm introductions to those investors, a CRM to manage a raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Itamar.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and FundingStack.com. Today I have Itamar Novick of Recursive Ventures. How's your day going?
It's going great. Thanks for having me on the show, Nathan. And thanks for everybody who's listening for joining us.
Yeah, happy Halloween. We're recording this on Halloween. Do you have a costume or any plans?
I am absolutely planning on, in terms of 4 p.m., I'm going to shut down my office and I'm going to head out there with the kids. I've got a 13 and 10-year-old. I'm going to wear my onesie and it's going to be a blast.
Onesie. So what's that? It's
a unicorn onesie. My daughter, she's 10. She loves unicorns. It's that age. So dad's going to be a unicorn this year.
Right. That's a good one. Yeah, my kids are similar ages and the older one is 14, I guess. And she says she's too old for trick-or-treating. I'm like, no, you're not. Get out there. You have to do it while you can. So
they still have candy at 14. That's what I hear.
That's true. Yeah. Very good. I'm going to be a cop, a police officer, kind of
yeah, we need more safety on our streets. Good job.
It's kind of, I shouldn't say it's on air, but it's kind of a sexy cop. It's kind of like a,
wow. Send us a picture then. Send us a picture. I want to see that sexy cop going on. That's interesting.
Picture the bachelorette party where the cop shows up at the door and then suddenly the music. Anyway, we're going to leave that.
I hope you'll get candy, not get candy thrown at you. That's
thrown at me, right? Eggs, candy. Yeah. All right. We should stop there on that. Cool. Well, let's just talk about what you do. What is Recursive Ventures all about?
Yeah, so Recursive Ventures is a VC firm focused on supporting founders at the earliest stages, getting from 0 to 1. We invest at inception in pre-seed and seed stage companies who are leveraging AI and data to disrupt antiquated services, mostly financial service, insurance, real estate. We're seeing all sorts of crazy new ways to automate and drive major productivity into those businesses using AI. And that's what we invest in.
What you give you don't have to name your favorites. Everyone has their favorites, but you're not supposed to say who that is. But what are some examples of like companies that are kind of doing that model, supporting that thesis?
Well, one of our unicorns, I've been very fortunate to have backed 7 unicorns at the get-go, like in the earliest stages. And one of them is, I think, a well-known now at this point, if you're in the sort of real estate or financial services business, is a company called Placer AI. And Placer AI basically has the best data on what's happening on the ground in the real world. So their foot traffic, let's say you run a mall, they're like, how many people show up? How much time do they spend? Where do they come from? Where do they go? Right? Is sort of one thing that you can do with that type of data, and AI forecasting on top of it. Another thing that you can do, if you're a hedge fund and you're trying to understand if, like, before the McDonald's earnings, if they're going to be, up or down, you can use Placer to forecast based on foot traffic what sales would look like ahead of earnings, and maybe, trade on that. So that's a perfect example of a company that caters to those industries, leverages data in unique ways, and then, with AI enables stuff like forecasting or deep analysis.
Yeah. Interesting. Okay, cool. And did you get into them at the seed round, or where are you investing typically?
So Recursive Ventures, and I'm the only GP of Recursive Ventures, but we're increasingly have a team of people supporting the fund. Is a pre-seed investor, so at inception, and then we do some seed deals. We typically write checks of $500,000 to $1 million just to get going. Many of our founders are repeat entrepreneurs who are kind of coming up for the next thing, and they want the funding to get going and be able to hire people and get stuff going faster. So that's the kind of deals that we tend to do. But then later on, as the companies evolve and we increasingly see, winners come across, we would continue to invest either through, reserves that we have, or we would put one-time syndicates in place to kind of increasingly back some of our biggest winners.
Okay, interesting. What's the fund size?
The current fund that we manage is a $30 million fund, and it's our fund 3.
Okay, interesting. 30 million fund 3. Yeah, we're going to get into that in a few minutes, talking about raising those funds, but let's stick a little bit more on your thesis and stuff like that. So you're on fund 3, and you're using, or you're focused on AI and data to disrupt older industries. But if you're on fund 3, I doubt you started with that thesis. What was your earlier thesis, or did you?
Yeah, so my 2 previous funds were actually angel funds that I was running when I was working and scaling up Life360, the last company I was a senior executive in, and also I bought out a founder in that company, which obviously made it a big bet on my end. I spent 12 years there, and I took the company from seed to IPO and beyond. It's now publicly traded on NASDAQ at over $7 billion market cap. So while I was doing that, starting 2014, I was forming small angel funds, which had some of my money, but other people's money as well. And that was Fund 1 and Fund 2 for Recursive Ventures. And I was moonlighting, investing, smaller checks into founders at inception, right? And only in the last 2-3 years have I started really scaling up Recursive Ventures. So Fund 3, but technically it's institutionalized Fund 1, right? I guess really, it's a process, right? With those venture funds, you kind of get the relationships going with the institutional investors, LPs, and we're sort of midway in that journey. So our next fund is probably going to be much bigger. That's kind of the expectation.
Bigger and more institutional. Okay, so yes. All right. Well, let's go into those. How you got to here. I always like the genesis story. Maybe let's start with the 3. What did Life360 do? What do they do?
Oh. I'm actually I'm surprised that you are not a Life360 user, because many folks our age in our state, having kids, teens running around with phones, actually use Life360. So Life360 is the family safety and peace of mind application. It's a mobile app. It gives you location and communication, so you can see everybody's location in real time, like Find My, but across any smartphone. And on top of that, we built a suite of safety products, such as crash detection and response. So if, for example, you or your loved one is in a crash, we know instantly, we know the severity of the crash based on your smartphone data, and then we try to call you up. If you don't pick up the phone, we would send an ambulance directly to the location of the accident with the indication of severity, and that is actually a life-saving feature that is paid. So Life360 today has over 50 million monthly active users in the US. It's actually one of the top 15 apps on the App Store, and has over 2.4 million subscribers paying between $9.99 and $19.99 a month for those additional services like digital safety, identity theft, crash detection and response, and other services that really help keep your family safe.
And think you said this, correct me if I'm wrong, that you were not the founder, but you bought out the founder. Is that what you said? Or you?
Well, it's an interesting story. I bought out a founder, but and buyout might not be the right word. I just bought his shares, right? But like, I was a VC on Sand Hill Road between 2010 to 2012, and one of the partners in the team sourced Life 360 at the pre-seed seed stage, and I actually ran all the diligence, and we passed in the deal. We didn't do it, and actually most people passed in the deal at that time. It was now very well understood. Life 360. People were like, "Oh, what is this? It's a tracker. I don't know. It feels bad." But what I saw as a VC was massive demand at the top of the funnel. Like people wanted this, and I said, "Yeah, I think on this one the VCs are wrong." I quit venture and I joined this company, and as part of that, I had the opportunity to acquire a position of a co-founder who previously left. So that enabled me to go all in, leave VC, and go into this company, and then build it for. Well, I was there for over 12 years.
That's interesting. That's a unique story. I haven't heard too many stories like that, where you're in VC, you leave VC, you join a company, you kind of get yourself into a co-founder role, so to speak.
Yeah, although just to be clear, I'm not a co-founder by title, but I think I've done very equivalent work.
Yeah.
Yeah.
Interesting. And all right, and then so while you're there getting this thing ready to go public, what was the IPO roadshow like? That's something we haven't talked too much about on this show. And years ago, I worked in investment banking, so I worked on some roadshows and stuff like that. And I think it's changed a lot. But maybe for someone who's in the founder's shoes at this point, thinking about a future IPO, maybe just give a little story of what that's like. Yeah.
That's an interesting one. Also, we did something very unique at Life 360, where in 2019, we actually took the company public. It wasn't ready for a NASDAQ listing, but we took the company public in the Australian Stock Exchange, in the ASX, and actually led the IPO as CFO. So it was an interesting experience for me because my background is actually engineering and product. I was not a finance guy. I was never a banker, but I was kind of the right person or the wrong person maybe at the right time and place. So because I built the finance and accounting teams, so it was a natural one for me as the person who's done a lot of the fundraising also in the company to kind of lead the IPO process. So yeah, we went public in Australia, which is a little bit unique. We were smaller back then. We had $30+ million of revenue, not like the 100 that you typically see in a NASDAQ. We listed in the Australian Stock Exchange at a little bit over $400 million market cap, US. And then that was in 2019. And then a year ago, 5 years later, we completed a dual listing. I was no longer the CFO. I wasn't even an employer, just employed. I was just, an advisor. Completed a NASDAQ IPO, dual listed essentially. But that was obviously much easier because we were already public and operate like a public company for 5 years. So it was more of like the market making in the US versus having to get to a point where you're IPO ready as a company. We were already operating as a public company. So, look, here's what I tell founders who ask me about going public. I tell them that it's not a liquidity event. One, I tell them that it's going to be more work, not less work. It's not an exit, right? And I tell them that you have to have true commitment to do what you need to do to run a public company. Which means that, to some degree, you're constantly on roadshows, you're constantly pitching, you got to spend time with the finance community, analysts, different equity players. You got to engage with them. You got to truly be able to do that well. And you're on the quarterly gerbil wheel. Like there's no other way around it, right? Like people are expecting you to give them very good indications on what's going on with your company and what's going on with the market on a quarterly basis, and you got to be able to do that. It's got to be compelling. It's got to be done right on one hand. On the other hand, obviously, lots more transparency, lots more scrutiny. Also, like if you're a CEO founder and maybe you've done really, really well at the earlier stages, you know how to build a team, doesn't mean that you know how to run a public company because you're going to be in the epicenter of a lot of pressure coming from public equity investors, employees, other executives. The pressure ramps up. So you got to be ready for all that. Obviously, there's a payout because now, it's liquid and you can make, it's good for the employees, it's good for the founders, it's good for, investors that jumped on the wagon along the way. Everybody's happy, but it's a big commitment. I think you have to be ready for it.
Yeah. I could go in so many directions here, but Did you say you delisted from Australia and then listed on NASDAQ, or dual listed?
Still listed in Australia. The company is dual listed.
Dual listed. Okay, gotcha. And I guess was the idea there is Australian? Does the company have Australian roots, or is it simply easier to get on the market in Australia?
Well, the ASX, one out of I guess three main exchanges who could potentially be an alternative to a growth round for private company startups, right? AIM is also there in London, the UK, and I think Toronto, like Canada, also has an exchange there. And ASX is one of them, and they were like heavily courting startups who are too small to list in the US, but already have a substantive business, right? And we have very close ties to friends in Sydney who know the local market well. We did, at the time, we had a lot of alternatives. We had, offers for a term sheet from another private investor. We had an offer to get the company acquired. We chose to go public because we felt that even though it significantly ups our commitment to the business and to our work, we felt like, first of all, it flattens the preference stack.
Okay.
And we had some corporate investors that were giving us a little bit of a hard time. We took a lot of strategic money at Life 360. I actually did a lot of that, raising money and closing deals with insurance companies and ADT, the home security company, and Samsung and whatnot, Verizon and whatnot. And some of those strategic investors, whether they're corporates or CVC, corporate venture funds, could potentially bring some commercial complexity along to the ride. Mm-hmm. And we had some concerns around that. So when you go public, all the preferred stock get flattened away and everybody's equal, right? Every shareholder is equal. And we actually saw that as an opportunity for us.
Okay. Interesting. We're going to move away from the IPO stuff in a minute, but is it difficult to be on two different stock exchanges? In other words, are there Australian financial reporting standards? And then there's, of course, US GAAP. Like, are you doing two sets of books? Is it doubling the amount of work to be on two separate markets, or what?
You're bigger experts than me on that because I never ran the company as dual listed.
Gotcha. Yeah.
But the short answer is yes. There are reported differences, IFRS versus different standards. It does cause some overhead.
Yeah.
But, we have a strong investor base in both Sydney and New York, and obviously globally. And there's volume on both. So I think, at least for now, it seems like the company went in the right path here.
Yeah. Yeah. Interesting. Yeah, it's something we haven't talked much on the show. Almost all these episodes are about raising your seed round, Series A, or
that's what I specialize in, by the way.
Yeah. So let's get back to that. All right. So, let's actually go through a bit of the history of raising a fund, because, like I mentioned, we do have emerging managers on this program. So you're at Life 360. You're building it out, taking it to go public. You mentioned you started to do some angel funds. Now, was that different than you were just making angel investments? Like, did you actually pool some money? And
yeah, I did. I did my first angel fund in 2014. It's called Recursive Ventures 1. It had some of my capital, but the vast majority of capital was other people's money. And what happened was, because I was already deep in the deal flow, again, I was a VC on Sand Hill, a junior guy between 2010 to 2012. Then I helped some friends set up an incubator, bringing Israeli companies. I'm originally from Israel, moved over to the base 16 years ago. I helped a group that was bringing Israeli companies to the Bay Area to sort of accelerate them. And that was also a fund. So I was very deep in the deal flow, and a bunch of friends, actually many investors from Life 360's early days, saw that I'm like, I was doing small angel checks, writing a $5,000 check here, a $10,000 check there. And I was introducing the companies to them, and they're like, oh, wow, you got some interesting deal flow. Why don't we just give you $1 million and you can independently start deploying capital on our behalf? Oh, it's sort of like an independent scout, right? Like some people, this is 2014, so it's early, but sure. Later on, a lot of people took scout positions in funds like Sequoia and Andreessen, and they were able to write small checks out of the fund. I actually chose to build a small institutional fund and write checks directly, not get compensated for management fees because I wasn't working full-time, but, sort of enjoy the upside with carry if we do hit winners. And it actually went really, really well. So I did one in 2014, one in 2018, and also that started doing syndicates in 2018 while I was building Life 360. And then, I started hitting a lot of big wins back then. Eventually I got into Deal as one of the first investors. That company is now valued over $17 billion. Probably the best investment I've made so far. Just outstanding how that team has executed. I am an early investor in Honeybook, which is a $2.5 billion unicorn. I'm an early investor in Placer AI, which is a $1.5 billion unicorn. I'm in May Mobility. I also invested more money in Life 360 for my funds, and that's obviously a great outcome, and so on and so forth. So what happened over the years in the 2014 to 2020 timeframe is that my funds actually started performing, like distributing DPI back to LPs, and people are seeing that, and that was really what propelled me to be in a position to raise an institutional grade fund that I'm running now. So I had the track record coming in of finding winners, deploying capital into winners, helping them raise subsequent rounds afterwards, and kind of supporting the founders through the whole journey, because I myself have gone from seed to IPO and beyond. So I kind of been through all those major inflection points of startups, right?
Yeah, it's interesting. Were those two funds actually set up as funds with all the back office and legal, or was it like an AngelList syndicate kind of thing, or what?
The first one was not. The second one was set up on AngelList, but it has a full back office and institutional grade in that sense. It is, got all the. I mean, the first one also got all the back office, like the accounting, the KY. You got to do that. That's like table stakes, right? And not even table stakes. It's illegal to do a fund without doing those things, right? And we take our operations very seriously. But they were. I think the difference now in Fund 3 or Institutional Fund 1 is probably the right way to call it, Recursive Ventures, is that we really have a team that's dedicated to operationalizing and professionalizing everything that we do. There is a difference between being an angel and being, a fund manager, and we take managing our clients' money very, very seriously. Like, it weighs heavily on our shoulders, and obviously we, institutionalize the processes, the reporting, compliance, fundraising from LPs is also a big part of this. You got to do this right. Communication, setting expectations, and so on and so forth. So we've done that over the last 3-4 years.
Would you, if you were doing this over again, would you still use AngelList as your back end for those sort of pre-institutional funds, or or would you do something else? I mean, the world is changing so fast, right? What would you do if you were doing that all over again? Partly I'm asking for those people who are maybe making some angel investors today, and they're thinking about following your playbook a little bit. Would you? Yeah.
I mean, look, there's a lot of vendors out there, and I think we're like that back office sort of fund admin function has been, has evolved a lot. Like, AngelList has different products. AngelList can help you run a small syndicate for a one-off deal, and they can, be the back office for $100 million fund. So does Carta. Carta is also able to do a lot of that, right? And there's other players in the space. So I think the bottom line is it's much, much easier as a fund manager, and it actually doesn't matter as much where you start. I think any of these platforms can support you. What really depends is what's your strategy. Like, if are you taking outside money? Are you doing syndicates, or are you doing a fund? It's like those answers to those questions and sort of how you want to build your venture business would dictate your wants and needs. The only thing I would say is, as you get bigger and more institutionalized, you're going to hit institutional LPs. Those are limited partners investing in funds. And I think their expectation, especially if they start writing bigger checks, is to get more custom, personalized experience engaging with your fund. And some of the platforms like Carta and AngelList are only now coming up to speed and being able to handle those institutions. So if you're raising a $50 million fund, I think you're fine with any of these. If you're generally raising $100+ million fund, I would make sure I've got the right vendors in place to do all the different things that you need to do in the fund, from KYC on LPs all the way to background checks and founders when you deploy capital. You got to have all those things in place eventually. And, sometimes you can't go to one platform to do it all. You got to do a best of breed and have different vendors and really have the capacity to do it right.
Let me dig into that just a little bit more, and then we'll move on to some other stuff, but maybe complete this sentence. To raise an institutional fund of a meaningful size, whatever, $50, $100 million plus, the things I need to do are XYZ. Like maybe in a short, almost bullet list format, what are the sort of the key things you need to do to institutional LPs? Yeah.
Differentiation. If you're
Yeah.
just one founder that manager that does X, unfortunately, in today's market, there's 1,000 like you. So how are you truly differentiated? One. Two is excess sourcing and getting allocations. This is not, if you don't have something proprietary there, if you can't say, I can get into deals X and get allocation in them when other people can't, I think you're going to have a challenge.
Yeah.
And three is, I think you have to be truly institutional grade. And what that means is that you have a repeatable, trustworthy process where you can show that over time you can, obviously with the right pacing and the right quality bar, deploy capital consistently. Because those LPs are not looking for one-offs. Like they want to underwrite you for 3 funds, which is a lifetime. It's like 15 years, 20 years of work, right? And to do that, you got to make sure that you have a group, you've got a team that's really dedicated to operating consistently at scale, operating well, so you can entrust them with institutional LP grade capital. Like somebody's writing $5 to $10 million check to your fund, that's a big allocation for some of these smaller funds, right? So you got to be at that level.
And you mentioned a few things in passing, but maybe summarize those. To be institutional grade, you have to have the back office reporting. What's the short bullet?
First of all, you got to have a repeatable, scalable way of sourcing and executing ideas and deploying capital. That's the basic, right? If you don't have that, then how can you be trusted with consistently deploying capital in the right places, right? So you need to have, to some degree, professionally set, from sourcing to close system, right? That's one. The second thing that you have to have is obviously the back office to support it, whether it's operational, transactional, finance and accounting, reporting, compliance. You really have to have those pieces in place because, look, a lot of those institutional LPs, they have folks that they report to as well. If they're fund of funds, then they have LPs like the funds have, and they need quarterly reports. It needs to be accurate. It needs to be audited, of course. So we have audit. That's another function that you need to figure out, right? And if it's not fund of funds, let's say it's endowments or even bigger pensions, they have even more scrutiny because they're representing the savings for thousands, if not hundreds of thousands of people, and they're obviously liable. You got to make sure that this is a trustworthy organization that spits out the right numbers, right? So you got to have those things in place if you want to have true institutional LPs take you seriously.
In terms of actually, we sort of talked about moving away as you're getting bigger, away from maybe the starting points of Angelus or Carta. Who are your hires for the back office? You have a fund accountant. Like, what's the sort of minimal viable team to have an institutional grade fund on the back office? Getting into the weeds here, but yeah.
An Angelus on Carta can do a lot of the back office work. Yeah. And it's not that expensive. It's definitely doable if you have, a $5 or $10+ million fund. You can pay these guys to do a good job on the back office. I think where it gets a little bit dicey is that even though you have a back office and you probably have a tax firm that you work with, and you probably have an accounting firm for your management company because there's a management company and there's the fund, right? I think what happens is over time as you scale, you need to have somebody who is coordinating among all these functions and making sure everything is right. So I think very quickly, especially if you're running a $20+ million fund, you're going to find yourself needing to having some sort of a temp CFO person internally who can oversee all the accounting, tax, finance, audit work, right? You also need to have some forecasting, budgeting, function at some point because, you're paying payrolls, you've got expenses. It's a business, right? It's a startup. Just instead of getting revenue from customers, it gets commitments from LPs, gets management fees, and deploys capital on their behalf, right? So it's a business, it's a financial services business. And I think you would eventually have to have the CFO and you know obviously need the lawyers to do anywhere from your documents to your compliance and all of these things. So I mean, if you want to put it all together, I'd say if you're putting a budget to like manage a small fund, and at least try to do it properly. I don't know what institutional means in this level. It's probably much more, but like if you want to do it properly, you're probably putting aside easily 100K, if not 150K a year to do that well. And then when you start scaling and you truly want to be institutional, you're talking about hundreds of thousands of dollars with, maybe a full-time CFO, you got a tax firm, you got an accounting firm, you got the back office, you got, the lawyers. The bigger you get, the more, help you need.
Yeah. Who else is on your team? It's you, and then do you have any other full-time employees, or the back office mostly outsourced?
Yeah, I know we do have a part-time CFO. He's great. We have a full-time chief of staff, and we use a mix of consultants on different things to get going. And then, although I'm the only GP, I do have venture partners in the business who are, amazing investors. Konstantin Otmer, who I've been working with for over a decade, is the best angel investor I know. He invested in Tesla before Elon was there. Is one of the first investors in Canva exits. Yeah. So he's working very closely with me on the investment side, but less on the back office.
Very cool. All right, let's go into a few different directions here. Just, you start doing the angel investing, the angel funds, starting to get a little more institutional. You mentioned some of the things you need, differentiation and access. So what was your differentiation when you decided to go raise, I guess, Fund 3 or the first institutional fund? Yeah.
My team's differentiation has always been, the few bullet points that lead there is one, we're operators ourselves. We built a business, and Konstantin works with me, has built 2 businesses and 4 actually, and sold 2 of them. So we're actually founders. We've been in the founder's shoes. You're talking to the single decision maker. So if you reach out to Recursive Ventures, you're not getting some associate talking to you. You're talking to me. You're talking directly to me, right? And I'm the sole decision maker at the end. So very nimble, very quick. We're actually as flexible and nimble as your business is, as it should be, right? Because it's a startup. So that's the first one. The second thing on the differentiation side is we have done extremely good work over the last 14 years, helping our companies raise the subsequent funding round from some of the leading VCs in the Valley, right? So we work closely with, all the mega funds like Andreessen and Excel and, all the funds that you would imagine that would come into a Series A and be able to really help scale the business. So that's the second thing that we've done really well. I've helped over 50 of our companies raise a Series A, right, over the last 12 years. So that's another point. And the third point is that we've actually been focused on data and AI, pre-generative AI, for close to a decade now. So I'm a data engineer by training. I built a significant data business at Life360 and kind of part of the data mafia, if you will, in the US. And really, when you think about AI, the AI is kind of broadly only as good as the underlying data. So our ability to really help evaluate your data, understand where different data sources could be, and kind of flow from there to building good AI systems is very helpful. So that's under differentiations. On the sourcing side, me and my team have backed over 500 companies in the last 25 years. So that's like 1,000 repeat entrepreneurs who know us and come to us to, build their next company. And we're the first check. So the network is just massive and very heavily Silicon Valley concentrated.